Welcome, everybody, to TheoTrade. This is Options 201 with Don Kaufman. We're going to start talking a little bit about vertical and calendar spread, the essential building blocks, really, of all options trading. So, again, welcome, everybody, here to Options 201. And this is going to be a multi-part series here. So, without further ado, let's jump into it a little bit with Options 201. And again, I feel pretty strongly about some of the material that we're going to be covering throughout this entire course curriculum, as verticals and calendars really are essential building blocks. Spreads are essentials. Now, risk disclosures, I always mention, we're not financial advisors or a broker-dealer. I do mention that because I spent 15 years, obviously, in the brokerage industry prior to launching TheoTrade. With that, options involve risk. All right. A little bit about me. Again, for those of you that are a little newer to this, and many of you are either watching this live or watching this in an archive over here. Again, my name is Don Kaufman, co-founder of TheoTrade. I had about an 18-year trading career, grew up around traders. 15 of those years were spent on the thinkorswim trading application, working with thinkorswim since 2000-2001 time frame. I also spent 5 years at TD Ameritrade after it acquired thinkorswim in 2009. I spent 5 years working as the director of the Trader Group, which included running many of the educational venues of TD Ameritrade, as well as helping design of the thinkorswim trading application and tools on the application. With that, let's jump into it here. Welcome, TheoTrader. So I always say this is kind of the next step towards learning option markets with TheoTrade. And I think that even though this is still kind of a more foundation class, I have tendency to teach the foundation classes quite differently, all right, than maybe some of you guys learned, for instance, vertical spreads or calendar spreads. So if you've got little experience with options, some of the material in this Options 201 course, probably going to be a little difficult to grasp at first. If you understand everything, then what's the point of, attending this, again, progression in this series here? But don't let it worry you if some of the stuff flies a little bit over your head. We're going to go through a lot of examples over here. It's our job through these classes, coachings, workshops, email us, okay, to help you understand all the concepts. So if you don't understand one of the concepts, hey, let us know. A lot of the stuff is going to be covered throughout the course of this Options 201, and what I don't cover during 201, we will put into a subsequent series over here. So we're really trying to build everything you need to know about options from A to Z. And however long it takes me and however many, course curriculums I need to put together, we're going to do exactly that. So again, just become familiar with the material in this basics course. It's going to help shorten your learning curve. And a lot of the learning curve is when you go out and you really want to start to execute and start to really start to trade these things. So a lot of the times, people will show you some system in trading. And again, we're going to go into Options 201 here. We're going to start with vertical spreads. But a lot of people show you systems in trading, and it sounds really good. But what happens when you start trading those systems? Okay, whatever it happens to be, whether it's, technical analysis system, give or take here or there, there's an option trade. Everything you do in options is going to be based off these, what we call kind of spread essentials. And the vertical spread is the first component. Now, I give everybody a heads up. Another in a little introductory over here, and I just put this together. This slide, I just added it last minute because I wanted you to know. You may not know this, even if you're experienced in trading. You might not know what we're going to be talking about over here. The first few slides of this 201 course, it's going to seem rudimentary to those of you that have spread capabilities. Those of you that know what verticals. So you're going to get bored, but I don't want you to tune out because, and I'll explain why here. Even the most experienced traders are going to learn little-known probability calculations, inverse spread tactics, okay? And it can help you substantially in your trading. So one of the things that I intertwine in here, and this, again, I'm speaking to those of you that have experience, all right, is that the techniques in here, I'm actually going to show you box spreads, which nobody talks about anymore, but it's essential to learn. Like if you People think about like butterflies and this and that and iron condors and all these different like vertical spreads. They're all based on the vertical spread. There's iron condors and there's butterflies and there's back ratios and there's this, that, and the other. And, if you understand what we do in this 201 class, you are going to be much better off, than most that are out there. This business is not that difficult. And people spend so much time like, let's do a class on broken wing butterflies. Let's do a class on butterflies. Let's do a class on iron condors. It's because they're selling you a class. You understand buying vertical spreads or selling vertical spreads, you're going to be way ahead of the curve out there. And that's one of the things. So let's kind of kick it off here with, again, as I said, the heads up, sit back, relax, learn the right way to use these spreads, buying vertical spreads. So again, we're kind of starting where we left off in the Options 101. And in Options 101, we left off with vertical spreads. Okay? So let's get into it. Buying vertical spreads. Buying vertical spread, it's a versatile strategy to use when you're confident a stock will move in a specific direction, okay? Or possibly stay relatively flat. All right? And you're like, wait, you could buy a spread and the thing can still stay flat, relatively speaking, and make money? Yeah. It just depends, on how you set that trade up. And everything here is like, well, how did you set the trade up? And we're going to look at just that. So, again, it does not employ the use of the stock. So we're going to use vertical spreads. We have no intention in use of the stock, only options, making this a relatively inexpensive method for benefiting from stock movement. So one of the reasons that people like vertical spreads is because you don't have to go out there necessarily trade the stock. And trading stock, that could bring a lot of undue risk, especially around like an earnings announcement. Go out and buy a stock. It's a $100 stock. You have $100 of risk. Well, these vertical spreads are really going to mitigate your risk. And that's one of the key benefits that you're going to learn. You'll hear that word mitigate. It just means, for instance, reduce risk, control risk, mitigate that risk. They're called vertical. All right. And the term vertical, like that eludes a lot of people. Like, why are these vertical spreads? They employ strike prices of the same month that are higher or lower than each other vertically. Like when people think of vertical spreads, and one of the things I start with here is, again, we've already covered some of the absolute basics of options, but when you look at like strike prices like here, for instance, is a $100 stock, and strike prices are listed. There'll be like a 105 call, then there'll be like a 110 call, then there'll be like a 115 call. These are listed vertically. And what a vertical spread does is it actually uses, two different options, which is exactly where we're headed. So, if you're curious of the names out there, just ask. People ask about like, what's an iron? They hear like these terms like iron butterfly. Iron means calls and puts. That's it. That's what iron actually means. It means calls and puts. Butterfly, well, butterflies, actual butterflies, I'm not talking about butterflies, in options, but butterflies have wings. So when you get a thing like an iron butterfly, it's nothing to do with the band. It means calls and puts with wings. That's it. I mean, not a whole lot went into the detail of coming up with that name, but these are called verticals because they employ strike prices that are listed vertically. Dun, 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 dun. Exciting stuff. So now we move forward here to vertical call and put spreads. In vertical spreads, you're paying a premium to buy one option, while at the same time you're collecting premium by selling another option. In a vertical call spread, buy a call, at one strike price and sell another call, at a different strike price. In a vertical put spread, what is it? You buy a put at one strike price and sell another put at a different strike price. Now we're just going through a little bit of the terminology in here. And the reason I put this, and it's, again, a little bit more vernacular, if you will. The reason I put this in here is sometimes some of you guys are really visual learners, and some of you are a little bit more into like, well, I just want to read through it. And it just depends, So if this helps you kind of visualize it, fantastic. But what we're going to do is we're going to go through here and start to build spread after spread after spread after spread. And again, the first First few slides we go through are going to be very, very rudimentary, and then we're really going to start to jump into the blocks and to put these spreads together over there. So as we move forward over here, love it. Anyway, I'm reading some of the chat room here too. When you start looking over here again, vertical put spreads, vertical call spreads, one of the things we'll start with is the call spread. And I'm going to start with the call spread because it tends to be easier. People get kind of confused with puts. You know, like I bought a put and I want the stock to go where? Down. Okay, you buy a put, you want the stock to go down. Then they're like, well, but I sold a put and I sold a put and I want the stock to go up. Yeah, but when you do a put spread, you're buying one put and you're selling another put against it. And people get confused. They're like, I am buying a put, so I want the stock to go down. I'm buying a put, which buys me the right to sell the stock. And then I'm selling a put, which, what? Sells yourself into an obligation for somebody else to sell you the stock. They're like, that's it, man. I give up. I can't even take it anymore. So we're going to start with like call spreads because I've been doing this long enough to know like put spreads are like I'm buying the right to sell and selling the right for somebody else to sell me. You're like, what? Okay. Vertical spread formula. And we're going to again go through lots of different examples here. And I'm going to take you through and kind of write a couple up on the screen. So we're going to buy one strike option, sell another strike option. Same series, calls with calls, puts with puts. Same expiration month. Same underlying asset. All right? What this basically means is this. Okay, let's start with a few examples, kind of move forward from here. And again, examples, it's, repetition is going to be important as we move forward. You always hear, repetition takes people a couple times to learn it. Well, in this Options 201, these building blocks, again, you get this down correctly, it is going to open up the door to you to so many different types of spreads. Okay, you don't have to take 20 different classes if you understand the logic we go through over the next few days here. So let's take a stock. It doesn't even matter what stock it is. And, so here is stock. And that stock happens to be right at, we'll say, 105. Okay, so it's at 105. Now, the assumption is you might think you know where the stock is going to go. Okay, you might think you know where the stock is going to go. Let's say on the stock we happen to be bullish. Now, one thing I'm not going to discuss extensively is how do you get bullish? How do you get bearish? Well, that we'll actually put a course together for. All right, we'll put courses together for technicals and so forth. Fantastic. So we brought a market technician on board here at TheoTrade. Nevertheless, let's assume that you're bullish on here. Right now, let's get down the spread basics. We're going to buy one option. And again, if we're going to be bullish, let's start with this idea. And we'll turn around and buy, for example, the 105 calls. You buy those 105 calls. And let's say, okay, that they're happen to be trading because they're termed what? What options are these? If you buy the 105 calls and the stock is trading at 105, these are termed the at-the-money options. The at-the-money options. And they're going to have a lot of value with them. Now, which calls do you buy? What month? Well, we're not going to get into expiration just yet. But we know that whatever I buy, okay, it's going to be the same expiration as what I do sell. All right, same expiration month. So I'm going to buy calls, and they could have about, let's say, 1 month of time. Okay, buy the 105 calls, and let's say they're trading for $3.50. Okay, now these are also going to have 1 month of time. As I'm buying the 105 calls, we're simultaneously going to be selling, okay, in this case, the 110 calls. Now, the 105 calls. Well, the stock is at 105. So what's the chance of the stock getting to 105? If it's at 105, well, there's a 100% chance of getting it to 105. All right, and those options are trading for $3.50. So we had to pay out $3.50 for them. Now, if you sell the 110 calls, now the stock's at 105. What's the chance of the stock getting to 110? Not as good, right? So if you look at the probability, this is your stock at 105. So here's the stock itself, trading at 105, right? and you're going out and you're buying a 105 call. 110 is all the way out here. So there's 110 call. Well, it's got to go a little further out. So these 110 calls, the reason I'm sketching this out, they're not going to cost as much as the 105 calls. All right. So what you're going to do is you're going to buy these guys and pay out 350 simultaneously. All right. Selling the other call against it. So what's the other call going to be trading for? In this case, let's put it at $2. So you sell one option for $3.50, you buy another option for $2. What are you in this spread for? $1.50. Now, this is buying a spread. You're into the spread for $1.50. Time out. And again, we're going to go through lots of examples throughout the course here of Options 201, because what you're going to find is there are umpteen different ways to do vertical spreads. Okay, this is buying a vertical spread. It's actually buying an out of the money vertical spread in this case. So buying an out of the money vertical spread. Okay, we pay $1.50 for it. A few things you have to realize. When you buy the 105 calls, it gives you the right to buy the stock at 105. When you sell the 110 calls, it obligates you to do what? Give somebody the stock at 110. So in this formula for vertical spreads, I bought one strike. Check. I did that. I sold another strike. Check. I did that. Okay. Same series. Calls with calls, puts with puts. Check. I did that. Why? Because we have calls. We have calls. Same expiration month. Check. I did that. They're both 1 month trades. All right. Same underlying asset. Yes, it's some stock. It's at 105. So we hit it. We hit all the variables right now of the vertical spread formula. Okay. Now it's just understanding in context that you have the right to buy the stock at 105. Somebody else has the right to take stock from you at 110. First thing you have to realize about vertical spreads, okay, is that it does limit your upside potential. Why? If you have the right to buy the stock at 105 and somebody else has the right to take stock from you at 110, how much can you make? All right? How much can you make on here? Because that's, hey, I mean, listen, this spread cost you $1.50. That's it. Spread $1.50. That's your risk, and your risk is limited to $1.50 over there, limited to $1.50. Fantastic. But how much can you make? Well, if you go out there and you have the right to buy the stock at 105, could you buy the stock at 105? Yes. What happens if the stock, though, went from 105 and shot all the way to 115? Ooh, no, it's at 115. Well, you have the right to buy the stock at 105. Yes, you do. Somebody has the right to take stock from you at 110, so they're going to take stock from you at 110 if they have the right to take the stock from you at 110, and it's trading at 115. So what happens? You make $5. $5, $5, $5, $5. This is known as a $5 wide spread. That's a $5 wide spread. And in a $5 wide spread, what's the most you can make? $5. What's the most you can lose? In this case, whatever you paid for it, which happens to be $1.50. Now, time out. We're going to go through a lot of examples similar to this, but we are going to take this trade, and I am telling you, even if you understand this right now, we're going to twist it and twist your head, okay? Because if you can understand just the very basics of this, there are ways to twist this spread to make it, again, infinitely more effective for you. All right, so let's move forward thinking about this example the entire way, where you're taking this $105 stock. You're giving yourself decent upside potential, but limiting your risk to $1.50, okay, per spread. But options don't trade in shares. Options trade in what? Contracts. And in this case, okay, option contracts, well, one contract is equivalent to 100 shares. This would cost you $150, plus whatever the transaction costs are. But transaction costs are going to be negligible. It's going to be negligible because we don't go out and pay like a $10 ticket charge anymore. You know, negotiate your transaction costs. We're at a place, it's a very happy place where now you can trade $105 stock with $1.50 at risk. Okay, moving along over here. Now we're actually going to get to some of the nuts and bolts. Risk and profit potential. The risk and the profit potential are both limited with vertical spreads. That's why I took you through the example. The profit potential can remain relatively high, while the risk is dramatically reduced. Buying a naked call or put can be expensive. The vertical spread reduces the cost by selling another option. So think about this, and again, in kind of context to the example that we did over here. See, some people go out, and when they first learn to trade options, and let's do it on the same stock. So we have a stock. Yes, I forgot the C. I just dropped the C because I like it. All right, stock, and that's the name of the company. The company name is Stock, and its stock is trading at 105, right? And some people go out, when they first learn to trade options, it's really alluring. They go out and they buy, for instance, this 105 call. And they buy that 105 call, they pay $3.50 for it. Now that's what we call buying naked call or put. Well, here's a call. So you're buying a naked call. So ultimately, you're buying this 105 call for $3.50. Now, if you buy a 105 call for $3.50 and the stock is at 105, where do you need the stock to go? You always look at everything worst case scenario. Now, people get into risk graphs and stuff. Yucky. Just look at it worst case scenario. Do the math. Buy the 105 call. You don't need stock at 105. You need it at 105 plus the $3.50 you paid for. So we're going to call this, from here on out, we're going to start looking at these. Okay, we're going to call it the break-even point. So better known as BE, break-even from here on out, is going to be at what? 105 plus 350, which takes us to 108.50. Look at everything worst case scenario, 108.50. That's just to be able to break even. Now, I actually call break-even point something completely different. I call it the point to which get your money back. You can write that down if you want. Getting your money back. You don't even get your money back until 108.50. And then plus transaction costs, which just tacks on a little bit extra to here. All right? But think about that. The point to which you get your money back is 108. So if the stock doesn't go up 350 in an allotted time, and that could be like 1 month, what are you? You're, a loser. I can't stand it. I just can't stand buying a call. You're like, but it has unlimited upside potential. Yeah, what's the probability of this stock going to infinity? Where is infinity? Is it an imaginary number? No, it's a real number. It's an infinity number, which can't even be described. Okay, so the only thing that has infinity, all right, attached to it is the FOMC. That's it, the FOMC. So maybe this stock turns into the FOMC, meaning like what? Infinity. Where's infinity? Infinity is some like ridiculous, like, but the stock could go to 120. Yeah, but what's the probability of it going to 120? That's probably like ridiculously low. But people buy calls. Why? I mean, it's a gamble. It's a total gamble to buy calls because you need the stock to go to 108 just to be able to break even. 108.50 for that matter, just to be able to break even. It's insane. So in a spread, everything's a trade-off in options. Everything's a trade-off in the marketplace. But it's really a trade-off in options because the risk and profit potential are both limited. So using a spread takes this 350 of risk, okay, and what does it do? It immediately chops it down to $1.50 of risk. And because it chops down to $1.50 of risk, though, does it reduce our upside? Yeah, it does reduce our upside. It reduces the profit potential. But I love it because it actually makes the world an easier, gentler place to live in. Because if you just buy the call, you know one of the most difficult things of buying a call? What is it? It isn't assessing the break-even point. The most difficult thing in buying the call, when do I exit? When do I exit the call? Because it has unlimited upside potential, I'm just going to hold it a little longer. Just a little bit more. Just a little bit more. Buying a call, okay, is reckless. It is reckless, all right? You don't do it. You want to live in this marketplace, okay? There's one thing I can tell you, and I say this without unequivocation, of 15 years in the brokerage industry, nobody survives buying calls or puts. They don't exist. They do not exist, okay? It's like trying to capture the Easter Bunny and Santa Claus all in one lump sum It ain't going to happen. Sure, people make money buying calls, but over the duration, you do enough trades, you lose money. It's an impossibly difficult trade from a probability standpoint because you got to go to 108.5 just to be able to do what? To get your money back. Don't call it break-even point. Call it the point to which I get my money back. But then it puts you at impossible odds as to know when to get out of the trade. You realize if you buy a vertical spread, you know when to get out. Why? Because your probability is better. But we're going to talk about probabilities a lot. But what's also much better than the spread, it maximizes what you can make. If we do a $5 wide spread, and that's what we talked about a little bit earlier there, but if we do that $5 wide spread, you know the most you can make is what? $5. So you make a $5 wide spread. The most you can make is $5. It's not that ambiguous, is it? All right? You know what you can make. You know what you can lose over there. That's it. So on that $5 wide spread over here, and again, we'll come over here and just look at that $5 wide spread. On a $5 wide spread, the most you can make is $5 wide. One of the areas, not only does it reduce the risk of getting in, but it also makes it easier to know when to exit. That's an area that people don't really think about. All right, moving along over here. And I don't spend a little bit of time on this one, but you got to look at like the benefits, the attributes of trading these things. And that's where I say even the most experienced traders, they miss it. They don't know where the attributes are because they never gotten taken through some of the basics, all right, of these. All right, continuing on, limited upside potential. A vertical spread's maximum value, whether it be a call or a put spread, can only go as high or as low as the difference between the two strikes used. So we've already reviewed some of this, but again, I like to go through thoroughly. So here we had the 105 call. All right, and this is the one that we're going to buy. Then we turn around and sell the 110 call. Now, the maximum value can only be the difference between the vertical spread. The difference is, well, this happens to be $5 wide spread. Okay, apparently I can't write. So $5 wide spread. And a $5 wide spread, the most you can actually make, $5. Now, be aware over here, spreads can change. Meaning, when I say spreads can change, you can make these variable, all right? No matter how wide or how shallow you want to make it. You don't have to have a $5 wide spread. I constructed a $5 wide spread because I think it's easy initially, example-wise. But when it comes to strike prices, as we learned in Options 101, you can even have dollar strike increments. Technically, you could do a 105, for instance, 107 spread. That $2 wide. One thing I want you to get used to at this point, always, just at a glance, identify the width of a spread. Like, know what you're looking at. If it's a $2 wide spread, if it's a $5 wide spread, call it that. Don't call it like a spread in Apple. Don't call it a spread in Google. Call it a $5 wide spread or call it a $2 wide spread. It's important because the width of this spread, this is going to be used later. The fact that this is a $2 wide spread, it's critically important because you're going to use the width of the spread to determine the probability later on. Again, the right building blocks is everything. The wider the spread, there's not necessarily drawbacks, but the wider the spread, well, the more money you'd be able to make. But the wider the spread then, probably more risk. A $2 wide spread, well, you can't make as much money. You can only make $2. But how much risk do you have up front? That's what we're going to start to look at, risk and reward in these. So it has limited upside potential. However, to continue on with this theme over here, again, the maximum value of a particular spread. The maximum value on vertical spreads. The max value on a 250 wide spread, right, is $2.50 or $250 per spread. Remember, options are traded on a what? Contract by contract basis. However, when options are quoted, like we'll call it a 250 spread, that's 250. Options are always quoted on a per share basis. So options are quoted on a per share basis, but they trade, for instance, in one contract. One contract is what? 250 times 100. Because there's what? 100 shares to every one contract equals $250. So the max value in a 250 spread, the max value in a $5 wide spread, right? That's like a 25-30 spread. We did a spread that was the 105, 110 spread. The maximum value, again, on a $10 wide spread. You could do $10 wide spreads. You know, there's certain products out there that are trading at like $2,000. The SPX is a $2,000 product. You could be bullish or bearish, and you could be doing like a 2,000, all right, and for instance 10 spread against a 2020. So a 2010 call versus a 2020 call, that happens to be a $10 wide spread. The bigger the product, okay, you could do wider spreads. It's not necessarily a bad thing. So just getting